right, as Senzo mentioned, my name is Mickal Adler, and I guess I have finally arrived. This is my first master class. I am now a master. I've never taught a class before in my life. I'm starting at the top. As a master of class today, this is now the Gulf of Adler. You will all call it the Gulf of Adler. And, I've never done this before. I've put together some slides to talk about funding and access to capital. So we're going to see how this goes. I have no idea how this is going to go, but I'm reminded of a George Carlin routine where he compares football to baseball, and he says, football is rigidly timed, and the object is to get to the end zone, and we are not going to give you 1 second more or 1 second less than the clock actually calls for. In baseball, the object is to go home, and we're going to give you lots of tries. And we're not going to time anything. We don't know when it's going to end. So this is going to be a lot like that. I have no idea how long this is going to take, when it's going to end. And so if you have questions, you might want to raise your hand and ask them while I go along, because I have no idea if I'll have time at the end. But we will see. I have my QR code up here. I'm also with Blue Williams Law Firm. But as Senzo mentioned, Boot64 Ventures, we invest in Louisiana impact startups. So anything that creates at least one job in Louisiana, we're interested in. We want to talk to all entrepreneurs, no matter what your venture is. We'd love to help you. So funding your dream. The most important part on this slide is So before you can start your capital journey, before you can talk to anybody about raising money or about getting money for your business, you need to understand what your business is. So there's so many types of business, and each one, just by its industry and its character, is going to call for a different, capital path. If you're starting a coffee shop, that's going to call for one set of assets, and you might be, it might be a little more capital intensive than, say, opening a law firm, where all you need to do is hang out a shingle, start marketing, and getting clients to walk into the door. If you're operating a car dealership, well, that's a massively different capital path, and it calls for different types of assets. You're going to need a physical premises, but then you're also going to need to finance inventory on a revolving basis. You're going to need a large line of credit. The floor plan line of credit is a big deal in that business. So every business is going to have its different capital path. If you're starting one coffee shop, because that's your passion, and you plan to operate that coffee shop yourself, that's one set of circumstances for raising money and acquiring capital to fund that. My recommendation is that you borrow as little money as possible and you don't take on any investors. But if what you're going to do is start a coffee shop, you're going to iterate new ways to serve coffee, attract new customers, you have formulations that nobody else has, and you're going to roll these out and open 500 of them, well, then you're going to be talking to investors. That's a different capital journey, and it requires, you'll have different milestones at which you might take on lots of money and lots of investors in kind of a different way than if you were just opening one coffee shop. So why are we talking about funding? Well, as we all know, something like 90% of new businesses fail. Of those failures, 82% of them go out of business because of cash flow issues. So I don't know which business person is attributed to the cliche that how does bankruptcy happen? Well, at first it happens slowly, and then it happens suddenly. And so your capital journey and your capital path is about projecting into the future. At the nearest scope, it's projecting that you can get to the next month. But you need to also be thinking about 6 months and a year and several years so that you can anticipate where that capital is. Because if you don't do that, if you just sort of think about your cash flow path as, well, I hope I'm going to make these 3 sales, but if I don't, I'll just figure it out. I don't know how much this construction project's going to cost, but I just have faith it's going to work out. What's going to happen is you're going to arrive at the office one day and think, oh, well, geez, I wasn't planning on that insurance bill coming this month, and I have payroll next week, and I just paid my rent, so the bank account's empty, and you're done. you'll have 5 times more obligations than you have cash in the bank, and you won't have time to get a line of credit in place, go out and raise money, find those investors. All those things take time. So you really need to always be thinking about where you're going, like driving a car. You can't only look in the rearview mirror. You got to look ahead, and you got to look ahead a pretty good ways in business. So what are we going to talk about today? As a master today, I wasn't always a master. I've had masters in my past. And when I was in high school, my sport was martial arts. And my master, Franklin Augustus, was a real badass. Can I say that? Can I say badass in here? And he had a mantra, and the mantra was stick to the basics, speed, power, focus. Now, I don't know if speed, power, and focus applies to your business, but sticking to the basics applies to all businesses and in many situations. And I've kind of lived my life a lot by that. You know, when you're in school, if you go to class, do the homework, and study for the tests, guess what? You are in the top decile. And if you figure out what your key performance indicators are in your business, or whether you're setting a track for raising capital, just stick to the basics. So this is a master class. I've got 18 minutes left. Nobody's going to be pulling out financial calculators here. We're not going to start doing, ROI or present value calculations on amortizations. So we're going to stick to the basics today. What are those basics? It's understanding the different types of funding that are out there, finding those funding sources for you, preparing to secure that funding, and then closing your deal. So what are the different sources? It's not tons. There's certain basic places people go to get funding for their business. The first is in your hip pocket. It's called bootstrapping, and it's your own money. I was in Austin about 3 weeks ago, and a venture capitalist said, if you're not willing to put money in your own idea, why should I? So when you start a business, that's the first place. If you don't believe in your business or your concept enough to put your own money in it, I guarantee you nobody else will. And for many businesses, that's the start and the end of it. You might want to be thinking about, how am I going to fund this? Let's say it's whether it's that coffee shop is a good example. Like I said, you want to think long and hard about taking on debt in a business like that, or investors, because those things come with obligations. These things on the list are not in alphabetical order. They're kind of in a logical order. The second place people tend to go after spending their own money, let's say you're out of it or you've reached the limit, you have bigger obligations, is friends and family. This is a big point. Now I see people in venture capital later in the process. They've already typically taken friends and family money. But it is a place that you really ought to think about if you're starting this journey. You can mess up your capital structure in your business by taking it the wrong way. You can also lose friends and family, because when you take their money, I know there's such thing as unconditional love, but when somebody owes you money, there's some conditions that come into play in those relationships. So, like I said, so friends and family, at that point, the point at which you start taking money from anybody for your business. And the other thing that's not on the list here, which I've mentioned a couple of times, of course, is credit. Talk to a banker about your capital path depending on your business. I know we have a lot of small businesses in here, not necessarily every one of them. In fact, most of the ones I heard mentioned a few minutes ago are not really businesses where you're going to take on venture capital. They're not high growth software type businesses. So, friends and family might be a temptation, but what you want to do is make sure you understand the right way to take that money. You might want to talk to a banker first and make sure that that's structured properly. If you are a high-growth business, one of the big dangers in taking friends and family money is that you don't appropriately value the portion of equity that you're selling, so that you either you sell too much of your company for too little money, which causes you problems later when you have to raise money again. Because any business that's going to really scale, that is going to go through several milestones, several marking posts of raising money, and you want to be able to sell another tranche of equity. If you sell 40% of your company for $100,000, well, what are you going to do when you need to sell another 20%? Well, guess what? Now you don't really own your own company anymore. Angel investors. So angel investors are basically high net worth people who invest in businesses. They're generally going to be investing in buying equity in your company. There's quite a number of them in Louisiana. You know, there's the Benson family, you've got Bollinger, the Stream family. So they're out there. They're not hard to find, and they're looking for you if you have a great business or a great opportunity or a great idea, and it's got a lot of opportunity to grow. They want to meet you. So angel investors come in the form of individuals. They come in the form of those family offices, and they also come in the form of angel groups. So a lot of them band together, and there's the Gulf South Angels. There's the Red Stick Angels in Baton Rouge, and what they do is they organize meetings where they invite founders in to pitch their companies, and then they make either individual or group investment decisions. This is a very good option for a lot of businesses. They tend to take more risks than other structured venture capital or private equity, and definitely more than banks. Again, banks are going to require a certain amount of security, EBITDA, other assurances that they're going to get repaid. And so a lot of small businesses are just at the early stages not going to be quite bankable yet. Venture capital. Now that's what I do. It's basically, from the small business side, you would look at maybe angel investors and venture capital in the same category. It's not dissimilar in terms of what you're trying to get. You're trying to get an investor. And in venture capital, the difference between venture capital and angel investors is really where the money's coming from. So what we do in venture capital is that we go out and raise money. So we pool that money into a fund, and then we put an investment process on the front end of it. So we do structured due diligence. We're representing investors in our fund, and we're making investments. In the case of Boot64, we write checks from $50,000 to $400,000, and we look at a lot of opportunities to do that. Crowdfunding. Today, that is a really viable option. Now, depending upon the venture that you're going into, there's really sort of three areas of crowdfunding. Let's say that you're actually starting a nonprofit, right? So there's the GoFundMe route. There's a lot of money is raised by crowdfunding these days on a GoFundMe type thing. If, on the other hand, you're starting a for-profit business and you have a product, huge companies have been built starting with Kickstarter. So if you have a product, the way that works in terms of crowdfunding is you make a pitch video, you structure what you do an online presentation of what your product is, and you offer basically discounts to early adopters. You accumulate enough orders to cover, let's say, that inventory is going to cost you $60,000 to have it manufactured at the factory. You can't afford to do that, so I'm going to wait till I get enough orders before I place that. So Kickstarter allows you to accumulate, prove you've got product market fit, prove that your price works, get some orders accumulated, and get that order placed. And you can churn that one or two times pretty easily if you have a good product. Let's say there's a famous case of a guy who put a Bluetooth speaker in an ice chest. He was trying to raise $20,000. He raised $2 million, and he built a huge company starting that way. There's another one. My family's in the jewelry business, and there's a watch called MVMT. Well, they're huge now. They started on Kickstarter. They did 3 or 4 Kickstarter campaigns. It's a $100 fashion watch. I say $100. It's really made for about $10 in China, and they sell it for $100. And they built a huge company. About 3 years ago, they sold it for $300 million. So that's another form of crowdfunding that doesn't involve actually selling a portion of your company. But you can sell a portion of your company on a Kickstarter campaign. There's WeFunder and Net Capital. Since 2015, this has been approved by the SEC. There's federal legislation that allows you to run a campaign to buy stock in your company. So it's the same kind of thing where you do a pitch video, you make the pitch for investment in your company, you set a valuation, you set terms, and then you can market that online. Generally, it's not going to just happen. You know, you need to be prepared to go out pitch. You would probably go to a lot of the same people that you'd go to if you were raising friends and family or that kind of strategy for raising money. The big advantage of this, and really anybody thinking about selling equity in their company ought to look at this carefully. The big advantage is, let's say, historically, if I've got a company and I want to sell 10% of my company for $250,000, but I've got a lot of friends who put in $100 or $500. Well, you can't do that. The reason you can't do it is to close a private stock transaction on a few $100s will cost you a few $1,000s in fees to get that done. You have to, there's SEC compliance, you'll definitely need a lawyer. It just can't be done. But with these crowdfunding campaigns, what you do is you sort of put in a chunk of that regulatory work up front, and then by the time you get that campaign launched, you can literally sell one share of stock for $100, and it costs you nothing. They take a little percent, I think it's 1 or 2%, and there's some upfront fees. But you can sell equity now with extremely low friction transactional costs, which historically was never possible before. And don't overlook grants, pitch competitions, right? This week is NOEW. There's a lot of pitch competitions going on. These are fascinating things. Senzo runs one on the North Shore where they gave away $150,000? $115,000 just a couple of months ago for a judged competition. These things are either grants, sometimes they're investments, but you can raise money if you have a compelling idea for a new business and you go around and you hit the circuit and start pitching it to people who might give you awards. Now, if you're in the science, you have news technology, there's a science, it might be something, you're working on something that applies to the government, a government contractor or a defense technology. Don't overlook going after grants. These SBIR and STTR grants are potentially available. Now, I say that with one caveat, which is that currently, we're in kind of a transition of administration at the federal government. A lot of these things have been paused today. They are absolutely not going away, especially the ones in the Department of Defense category. That's going to be well funded going into the future. Small business really is one of the technological innovation engines for big government. It's not everybody really realizes that the government doesn't do a lot of their own internal scientific and technological innovation. They're funding small businesses to do it. They give them money to give these things a try. They see which ones work, and then they buy those. They fund those companies with grants. They fund them with contracts. They potentially buy those technologies from small companies. So that's, depending upon what you're working on, is potentially a really viable source of funding. All right, I am running really behind, so there's going to be no time for questions if you don't raise your hands now. All right, KYF, know your funder. So when you start, after you've identified the people you might go pitch for money, make sure you understand what their strategies are, because you don't want to waste your time pitching to people who are the wrong fit for you. Every funder has sort of a thesis. They have certain check sizes. They have certain expectations of how much of the company they want to buy or they want to own. They have potentially, a focus in whether it's software as a service, or it might be CPG, or it might be defense technology. Every fund, every funder has a kind of a sweet spot that you want to learn before you go and pitch that source of capital. And the other thing you want to understand is their decision-making process and their timeline. Very few of these larger funding sources are going to be quick, so you need to prepare yourself for their process. There's one of my best friends from high school. He said his dad drilled this into his head his whole life. Proper prior planning prevents poor performance. So when you're getting ready to go pitch somebody for money, you need to have your ducks in a row. A solid business plan, a written business plan is a big help. They don't want to be talked to for an hour for you to explain all the intricacies, but if you can provide them with a document, that's a big help, especially if it has financials associated with it. Projections out as long as you can reasonably make those projections with appropriate assumptions, which you disclose what those assumptions are so that they can evaluate it. That's really important. You want your legal structure to be clean. I mentioned, don't take the wrong money too early. When they're going to look at what we call the cap table, which is sort of the list of all the stockholders in your company and how much they own. You want that to be clean. The good thing about those crowdfunding campaigns is you end up with one entry on your cap table, you sold 12% of your company. But that represents maybe 500 people. You definitely don't want to hand somebody a cap table that has 500 people on it. They won't even talk to you. So think about a clean structure, something that is what we say is investable. You don't want some customized LLC that they look at and say, we can't even figure out what this is. We can't invest in it. Some type of pitch or validation of your product. Of course, you want to tell a compelling story. So how do you close that deal? Well, the first thing is make your story relatable. You're going to have to stand up like I'm standing up in front of you now and make a pitch to somebody. You want that pitch to be compelling. You want to show why you. So tell them what's your passion about this. A lot of great founders, what they're doing is they're solving a problem that they themselves had or a challenge they had to overcome, and they have a really great business plan as to how to help other people overcome that challenge that they had. There's a reason that they developed the product that they have. You want to also create urgency. So there's a lot of forms of that. Maybe there's a market condition or an opportunity that's only happening now, or that's happening for the first time now, so that the first people in this market are going to take best advantage of it. One of the best sources of creating urgency is, let's say you're trying to raise $400,000 for your business, and you're pitching an investor, and you can go in and say, well, I've already got $300,000 committed. Well, that creates an urgency that they're going to miss out on the opportunity if they don't invest soon. Be concise. Unlike what I'm doing with my pitch, you want to be quick and on time with your pitches. You want to know your numbers. You want to show traction and momentum. And definitely don't try to oversell, overpitch, be defensive, or misrepresent anything. An investor will sniff those things out, and they look at a lot of deals, and they will pass you by quickly if you're not honest with them. The next steps after you make your pitch and say that they're interested, the first thing you'll get, even from a bank, will be a term sheet. So all these things will come with, let's make sure we understand the basic terms that we're going to invest on. There are different types of funding documents. You want to understand what's implied in those terms. If you're talking about debt, you certainly want to look at your default provisions, understand your full cost of that debt in terms of not only interest but fees. That basically adds to the financing cost. For you selling equity, you want to understand the basic terms of that valuation. How much dilution is, how much will that investor end up owning after you've, say, had your exit, sold your company, or you've gone public, or that type of thing. The process is going to involve some due diligence, and you want to be ready for that as well. The documents that you prepared for your pitch, the documents that you've put together for your organization, you want to put those in what we call a data room. Once upon a time, you might have put a set of documents in a big box and dropped them off at a lawyer's office. Today, what's expected of everybody really is that you have those in an online Dropbox type thing. There's quite a number of them available, so that when the investor says, okay, can I see your data room, all these things are there for them to study: your business plan, your financials, your projections, your pitch deck, your cap table, your corporate organizational documents. Those are the basics that everybody expects to see in there. They want to click on a link and see all those documents in a secure room. These things are secure. You approve them by the email address of the person that you're letting in there. And then you're going to get to some closing documents. At this point, unless you're a lawyer yourself, I would say call a lawyer. Jared, where are you? Call Jared. I'd say call me, but he's the big sponsor today, so we want you to call Jared when you get those closing documents, and make sure that your interests are being protected, that you fully understand every one of those terms. And the one thing that I will tell you, advice for hiring lawyers is, look, it's not rocket science. Read the documents yourself, wrestle with them. You'll have questions, write down the questions. Your lawyer's your best friend. He's going to explain those things to you. And plus, you make his job easier. The last thing the lawyer really wants is say, look, here, make sure this is okay, and you give him a stack of documents. That's going to be massively time-consuming, massively time-consuming, and it'll cost you more money. So I would recommend read the documents, understand them yourself, and because it's part of the hard work of closing the deal. You close the deal, you got the money. Guess what? Bad news, it's not over. You want to communicate regularly. You want to deliver on your milestones. So if you say your sales are going to be X this year and they're going to be Y next year, you want to make sure that you fulfill those promises, and you want to be honest and transparent. When I say communicate regularly, I started this with telling you that one of the biggest risks in small business is running out of money. The last thing we want is the call from somebody in our portfolio to say, guess what, we're completely out of money. Well, my question is, why didn't you call me 60 days ago? You should have known you were running out of money. We can help you. You know, if you have to go out, we have to go raise some more money. If we have to secure a line of credit, whatever, we're here to help you. We don't want you to fail. Don't wait till the last minute. Communicate, try to meet your milestones, and be honest. Let's see, how we doing? All right. I'm over time. So if you have any questions, I can see you guys later. I'm going to keep Senzo on time because he'll be mad at me. He won't invite me back. Thank you all very much.